Stop right there. I need to talk to you about something critically important. Something that could silently snatch hundreds, even thousands of dollars right out of your pocket without you even realizing it until tax season hits. This isn't just some boring tax jargon. This is a real-world financial trap that ensnares countless investors every single year, and I'm here to make sure you are not one of them. We're talking about the wash sale rule, and understanding it is absolutely non-negotiable if you're serious about managing your investments and, more importantly, saving your hard-earned money from the clutches of an unexpected tax bill. Here's the reality. In the world of investing, especially when markets are volatile, it's incredibly common to find yourself holding on to stocks that dipped in value. It's frustrating, it's stressful, and your natural inclination, a smart inclination, is often to sell those losing positions to harvest those capital losses. Why? Because those losses can be used to offset capital gains or even a limited amount of ordinary income, which can significantly reduce your tax burden. It's a fundamental strategy for tax-efficient investing. But there's a huge, often overlooked landmine waiting for you right there, and it's called the wash sale rule. Let me explain why this matters, why it's so insidious, and how you can absolutely avoid this nightmare scenario. The Internal Revenue Service, the IRS, they are not naive. They know that investors would love to sell a stock for a loss, immediately buy it back, and then claim that loss deduction, all while maintaining their position in the market. That's essentially having your cake and eating it too from a tax perspective. And the IRS, in its infinite wisdom, said, nope, not on our watch. That's the core essence of the wash sale rule. It's designed to prevent you from creating artificial losses just for tax purposes, while essentially keeping your investment position unchanged. Now, let's dive into the nitty-gritty, because this is where people get tripped up. A wash sale occurs when you sell or trade stock or securities at a loss, and within 30 days before or after the sale, you buy substantially identical stock or securities. That 30-day window is absolutely crucial, and it's the part that catches most people off guard. It's not just 30 days after you sell, it's 30 days before or after. That means if you bought the stock, then sold it for a loss, and then bought it again within that 61-day period the day of sale, plus 30 days before, plus 30 days after, you've triggered a wash sale. The consequence? The loss you thought you were going to claim? It's disallowed. Poof. Gone. For tax purposes, it simply doesn't exist. Now, it's not entirely lost forever. The disallowed loss is actually added to the cost basis of the newly acquired stock. So when you eventually sell that new stock, you'll have a higher cost basis, which could result in a smaller gain or a larger loss down the road. But here's the kicker. You've lost the immediate tax benefit, the immediate deduction you were counting on for this tax year. And for many people, especially those who are actively managing their portfolios, that immediate deduction is precisely why they sold in the first place. Imagine you are an enthusiastic, diligent investor. Let's call you Alex. Alex bought 100 shares of Company X at $100 per share. The market takes a dip, and Company X drops to $80 per share. Alex, being smart about taxes, decides to sell those 100 shares, realizing a $2,000 loss. Fantastic, Alex thinks. I'll use that $2,000 loss to offset some capital gains I had from another successful trade earlier in the year. But Alex still believes in Company X's long-term potential. So, just 5 days later, thinking they're being clever, Alex buys back 100 shares of Company X, perhaps at $82 per share. Still getting a good deal. Sounds reasonable, right? Wrong. Alex has just committed a wash sale. Because Alex bought substantially identical stock within 30 days of the sale, that $2,000 loss is disallowed. It's added to the cost basis of the new shares. So instead of a cost basis of $82 for the new shares, it becomes $82 plus the $20 disallowed loss per share, making the new basis $102,000 per hour. This means Alex won't get that immediate tax deduction for the $2,000 loss this year. This is precisely the kind of scenario I want to save you from. It's a silent killer of tax deductions. Now, let's talk about the common misconceptions that lead people directly into this trap. A lot of investors think, oh, I'll just sell it in my brokerage account and then immediately buy it back in my Roth IRA. Or I'll sell it in my individual account and have my spouse buy it in their account. Stop right there. This is a critical point that many people get wrong, and it can lead to a much bigger headache. The wash sale rule applies across all accounts you control, even your IRAs, 401ks, and other retirement accounts. And yes, it also applies to your spouse's accounts. So if you sell XYZ stock for a loss in your taxable brokerage account, and your spouse buys XYZ stock in their taxable account within that 61-day window, guess what? Wash sale. The loss is disallowed. The IRS views you and your spouse as a single economic unit for this purpose. The complexity doesn't stop there. What about substantially identical securities? This is another huge area of confusion. It's not just about buying the exact same ticker symbol. The IRS considers securities substantially identical if they are essentially the same in all material respects. This definitely includes shares of the same company, even if they're different classes of stock, like Class A versus Class B, if they have similar rights and privileges. But it can also extend to things like options. If you sell a stock for a loss and immediately buy an in-the-money call option for that same stock, that could very well trigger a wash sale. Or what if you sell an ETF that tracks the S&P 500 for a loss and then immediately buy another ETF from a different fund company that also tracks the S&P 500? In many cases, the IRS would likely consider those substantially identical because they are designed to track the same underlying index and provide essentially the same investment exposure. This is a gray area, and it's always safer to err on the side of caution. If it looks, walks, and quacks like the same duck, the IRS will probably treat it as such. So how do you avoid this nightmare? The solution is thankfully straightforward, but it requires discipline and awareness. The simplest way to avoid a wash sale is to simply wait out the 30-day period. If you sell a stock for a loss, you must wait at least 31 days before repurchasing that exact same stock or a substantially identical security in any of your accounts or your spouse's accounts. That's it. It's a waiting game. Another strategy, if you truly believe in the sector or asset class but not necessarily that specific company, is to buy a different security that is not substantially identical. For example, if you sell Apple stock for a loss, you could immediately buy Microsoft stock instead. They are both tech giants, but they are distinct companies, and buying Microsoft would not trigger a wash sale for your Apple loss. Or, if you sold an S&P 500 ETF, you could buy an ETF that tracks a different index, like the Nasdaq 100 or a total market fund. The key is to ensure the new purchase is truly different enough to not be considered substantially identical. This requires a bit of research and careful consideration, but it's a perfectly legitimate way to maintain market exposure while still harvesting your losses. Now let's consider who this impacts most. If you're a new investor, perhaps a student just starting to dabble in the stock market with a few hundred or $1,000, you might think this doesn't apply to you. You might be making small trades, buying and selling quickly, trying to learn the ropes. But guess what? Even a small disallowed loss can have an outsized impact on your meager earnings or limited deductions. You're trying to build good habits, and understanding this rule from day one is crucial. Don't make this rookie mistake that seasoned investors fall into. For the freelancers and small business owners out there, every single deduction counts. You're already juggling so many financial balls, and an unexpected tax liability because of a wash sale can be a real punch to the gut. You're probably looking for every legitimate way to reduce your taxable income, and capital loss harvesting is a powerful tool. Don't let a simple misunderstanding of the 30-day rule negate your efforts. For retirees or those nearing retirement, preserving capital and managing your tax burden is paramount. You're relying on your investments for income, and you're likely in a stage where minimizing taxes on distributions and gains is a top priority. Falling victim to a wash sale could mean you miss out on crucial tax deductions that could have helped extend the life of your portfolio, or reduce your overall tax bill in a year when every dollar truly counts. This isn't just about losing a deduction. It's about eroding your financial security. The psychological aspect of this rule is also fascinating. I know you're thinking, this feels unfair. I lost money, why can't I claim the loss? And you're right, it feels counterintuitive. But the IRS's perspective is about preventing manipulation. They want losses to be real, genuine, and not just a quick paper transaction to reduce your taxes while you effectively keep your investment. It's a rule built on the principle of substance over form. So while it might feel frustrating, understanding the intent behind the rule can help you navigate it more effectively. My urgent advice to you is this: track your trades meticulously. If you're selling a security for a loss, make a note of the date. Put a reminder on your calendar for 31 days out. If you're using a modern brokerage platform, they often track wash sales for you and will report them on your Form 1099 BABI, but don't rely solely on them. Be proactive. Understand the rule yourself. When in doubt, always consult with a qualified tax professional. They can help you navigate the nuances, especially around what constitutes substantially identical in complex situations. Don't guess when it comes to your taxes and your money. This rule, while seemingly simple, has so many subtle traps that can cost you dearly. The wash sale rule is not there to punish you. It's there to ensure fairness in the tax system. But ignorance of it will punish your wallet. So remember that 30-day window. Remember it applies to all your accounts and your spouse's accounts. And remember what substantially identical truly means. Be vigilant, be informed, and protect your hard-earned investment deductions. You've worked too hard for your money to let a simple rule like this snatch it away. Stay smart, stay informed, and keep more of what's yours.